When the market collapsed in 1929, millions lost everything, except one man who made more in a day than most earn in a lifetime. 80 years later, the same pattern made billions again in 2008, and it's starting to appear one more time. Picture this: October 24th, 1929. The trading floor of the New York Stock Exchange erupts into chaos. Men in silk ties and pressed suits scream across the marble halls as fortunes evaporate in minutes. Outside, crowds gather on Wall Street, their faces etched with disbelief as the unthinkable unfolds. The greatest bull market in American history is collapsing, taking with it the life savings of millions. But in a corner office overlooking the carnage, one man calmly places another trade. While the masses panic, he profits. His name is Jesse Livermore, and by the day's end, he will be $100 million richer. This is empire economics, where history and money collide. And today, we uncover one of the most fascinating patterns in financial history. The same strategies, the same mindset, the same type of investor has made billions during every major crash for nearly a century, from 1929 to 2008, and they're positioning right now for whatever comes next. What separates these legendary figures from the millions who lose everything? It's not luck. It's not insider information. It's something far more systematic, something you can understand and learn from. Because while most people see market crashes as disasters, a select few see them as the greatest wealth transfer events in human history. Let's start with the foundation. Every great crash follows the same blueprint. First comes euphoria. Markets soar to impossible heights. Everyone believes this time is different. The newspapers celebrate endless prosperity. Regular people quit their jobs to become day traders. Then comes the moment of recognition. A few sharp minds realize the party is about to end. They don't just exit the market, they position themselves to profit from its collapse. Finally comes the reckoning. When panic strikes and fortunes crumble, these contrarian investors collect their winnings while others count their losses. Jesse Livermore understood this pattern better than anyone. Born in 1877, he started as a chalkboard boy at a brokerage firm, earning $5 a week. But Livermore possessed something rare: the ability to read market emotions like a psychologist reads human behavior. He spent years studying price movements, identifying patterns that others missed by the time he was 16. He was already trading with real money and winning. Livermore's genius wasn't in predicting specific events. It was in recognizing when markets became disconnected from reality. During the Roaring Twenties, as stocks climbed higher and higher, most investors saw only opportunity. Livermore saw danger. He noticed the warning signs that euphoria creates: ordinary people borrowing money to buy stocks, companies with no profits trading at astronomical values, the same conversations in every barbershop and taxicab about easy money in the market. So while everyone else was buying, Livermore was quietly building short positions. Short selling allows investors to profit when prices fall. You borrow shares, sell them at the current high price, then buy them back later at a lower price, pocketing the difference. It's simple in concept, but requires nerves of steel in execution. Because when you're shorting a rising market, you lose money every day until the crash actually happens. For months, Livermore watched his positions move against him as stocks continued climbing. Lesser investors would have panicked and closed their trades. But Livermore understood something crucial about market psychology. Bubbles don't gradually deflate. They burst violently and suddenly. The higher they climb, the harder they fall. Then came Black Thursday. The market opened in chaos. Panic selling overwhelmed the exchanges. Stocks that had been worth fortunes the day before became worthless paper, and Jesse Livermore's short positions exploded in value. In a single day, he made over $100 million, equivalent to more than $1 billion in today's money. While banks failed and millionaires jumped from windows, Livermore had positioned himself on the right side of history's greatest financial collapse. But Livermore's story reveals something even more important than his trading genius. He understood that crashes aren't random disasters. They're the inevitable result of human psychology meeting financial mathematics. When fear takes hold, it creates a self-reinforcing cycle. Falling prices trigger more selling. More selling drives prices lower. Margin calls force even reluctant sellers into the market. The spiral feeds on itself until assets trade at fractions of their true value. This is where the real money gets made. Not in the initial crash, but in the aftermath. Smart investors don't just profit from the fall. They use the chaos to acquire quality assets at fire sale prices. They understand that markets eventually recover, but the wealth transfer is permanent. The panicked sellers don't get their money back. It goes to those who had the courage and capital to buy when everyone else was selling. Fast forward to 2008, and the pattern repeats with surgical precision. But this time, the players have evolved. Meet Michael Burry, a former neurologist turned hedge fund manager. Like Livermore before him, Burry possessed the rare ability to see what others missed. In 2005, while the housing market soared and mortgage-backed securities were considered the safest investments on earth, Burry began his research. What he discovered horrified him. The mortgage market had become a house of cards built on lies. Banks were giving loans to people with no income verification. Real estate prices had disconnected from any rational measure of value. The entire financial system had convinced itself that housing prices could never fall nationally. Burry knew this was impossible, and he began planning the trade of a lifetime. The problem was that you couldn't simply short the housing market like Livermore had shorted stocks. There was no direct way to bet against mortgage-backed securities, so Burry did something unprecedented. He convinced major investment banks to create new financial instruments called credit default swaps. These were essentially insurance policies that would pay out if mortgage securities collapsed. The banks were happy to sell these swaps to Burry. They thought he was crazy. Housing had never crashed nationally before. They were collecting premium payments from him every month while his positions moved against him. For 2 years, Burry paid millions in premiums while watching housing prices climb even higher. His investors questioned his sanity. The media mocked his predictions. But like Livermore before him, Burry understood that the bigger the bubble, the more violent the collapse. Then came 2007. Housing prices began to stumble. By 2008, the collapse was in full swing. Lehman Brothers collapsed. Bear Stearns was sold for pennies. The global financial system teetered on the edge of complete breakdown, and Michael Burry's credit default swaps exploded in value. His fund made over $800 million. He personally earned $100 million. But that was nothing compared to what came next. While Burry was collecting his winnings from the housing collapse, another figure was orchestrating something even more spectacular. John Paulson had built his hedge fund on merger arbitrage, a specialized corner of finance far removed from housing markets. He had no background in real estate, no expertise in mortgage securities. What he had was something more valuable: the ability to recognize when an entire system had lost touch with reality. In 2006, Paulson began studying the same mortgage data that had caught Burry's attention. But where Burry saw individual bad loans, Paulson saw something bigger. He saw a systemic failure that would cascade through every level of the financial system. Banks weren't just making bad loans. They were packaging those loans into securities, selling them to pension funds and insurance companies, then using the proceeds to make even more bad loans. It was a machine designed to multiply risk, not eliminate it. Paulson's approach differed from Burry's surgical precision. Instead of betting against specific mortgage securities, he wagered against the entire system. His fund accumulated credit default swaps on a massive scale, building positions worth billions of dollars. His investors watched in horror as he paid enormous premiums month after month, waiting for a collapse that seemed like it might never come. Then 2008 arrived with devastating force. As housing markets crumbled, Paulson's positions began printing money at an unprecedented rate. His hedge fund generated over $20 billion in profits. Paulson personally made $6 billion in a single year, earning roughly $10 million per day during the height of the crisis. It was, as some on Wall Street called it, the greatest trade in history. But here's what makes this pattern so remarkable. While Livermore, Burry, and Paulson were profiting from collapse, another legendary investor was playing an entirely different game. Warren Buffett watched the 2008 crisis unfold with the same calm calculation that had made him one of the world's richest men. But instead of betting against the system, he was preparing to rescue it. As panic gripped financial markets and credit froze, Buffett's Berkshire Hathaway became a lifeline for struggling companies. In September 2008, as Lehman Brothers collapsed and fear reached fever pitch, Buffett struck a deal that would become legendary. He invested $5 billion in Goldman Sachs, not in common stock that could lose value, but in preferred shares that guaranteed him a 10% annual dividend. The terms were extraordinary. Goldman was so desperate for capital that they agreed to pay Buffett $1.5 million every single day just for the privilege of using his money. When Goldman redeemed the shares 3 years later, Berkshire Hathaway had earned over $3.5 billion in profit. Buffett had turned crisis into opportunity, not by betting against the system, but by providing stability when stability was worth its weight in gold. This reveals something profound about crash profiteering. It's not just about predicting collapse. It's about understanding how fear creates opportunity. When everyone is selling, assets become available at fractions of their true value. When credit disappears, those with cash become kings. When confidence evaporates, those who can provide certainty can name their price. The pattern extends beyond individual trades to entire investment philosophies. During the Great Depression, while most Americans lost everything, a select few accumulated vast fortunes by buying real estate, businesses, and stocks at Depression-era prices. Paul Getty, the oil tycoon, built his empire on a simple principle: buy when everyone else is selling, hold until everyone else is buying. The pattern is clear. From Livermore's calculated rebellion in 1929 to Buffett's strategic rescue in 2008, the greatest fortunes aren't built on luck or insider secrets. They're built on understanding human nature when it collides with financial reality. These investors didn't just predict crashes. They understood that panic creates the greatest opportunities in history. The question isn't whether the next crisis will come. The question is whether you'll recognize the patterns when it arrives. History never repeats, but human nature always does. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If you enjoy learning how history and money intertwine, subscribe to Empire Economics for more untold stories.